Well. Good afternoon to everyone out there. How are you guys doing? I'm Anthony Murray, and welcome to Financial Sense. Hey, today is going to be an awesome day. An awesome day. Now, if I seem to be tired to you guys, guess what? You are not imagining anything. I am tired. I've been on the go since 4:20, 4:28 this morning. My body is saying, man, what are you doing? Why don't you just do a rerun and go to bed somewhere? But I'm not going to do that. I have a very special guest. His name is Blake Grant. Now, he's an RVP with the company we call AMS. He's going to tell you a little bit more about himself. But before we bring him on, did you or do you know what this month is? It's the month we enter into spring. Where is the year going, y'all? Where is it going? Where is it going? I mean, what is it? March 20th is spring? Listen, what happened to the winter? I'm so glad it was short. I'm so glad it's over. I am not a winter person, even though I grew up in the north. Well, I guess I am kind of a winter person. I do kind of like the cold, but not the frigid cold. Man, and this year in the area of Georgia I'm in, it was chilly. Yeah, I'm not talking about the chili that you put crackers in and beans. No, it was cold. Man, it was cold. So listen, we're going to have a good day today. We're going to talk about something that is very important for all of you that's in my generation. All right. I'm in my 60s. I'm in my mid-60s, right? And I think we have the greatest, absolute greatest generation that ever walked on planet Earth in the USA. So listen, it's going to be very interesting. A lot of people in my generation, you know what we're not ready for? Retirement. That's why the door greeters in most of the stores today are old or look old anyway, right? I mean, I ran into some folks my age. I'm 65. No shame about it. 65. But man, they look like they were 10 years older than me. I'm like, what in the bejesus happened to you? But hey, you know, life happens. Life happens. You know, the worst case scenario is this. A lot of folks are not ready for retirement. It's plain, it's simple, it's honest. A lot of people are not ready for retirement. I ran into someone not long ago who I thought they were going to start crying. They just started saying to me, they said, I don't know what I'm going to do. I said, what you mean? That I don't know what I'm going to do. They only have so much money in their 401k. Now, look, I am not a security licensed individual, so I'm not going to tell you to buy this in securities or to buy that. But I will say this because it's public knowledge that yes, your 401k could run out of money. But what if there's a way? What if there's a way that you could take that 401k, put that money into something, and never ever have to worry about your money running out? Now, that individual that I was talking with, he's in his late 60s, mid 60s. We're around the same age. You know. And so, yeah, we're the group that fought in World War II and Vietnam and probably Korea and who knows what else, and on the streets too, right? So listen. Without any further ado, I want to bring in this gentleman, Mr. Blake Grant, and we're going to talk about this for the next hour or thereabouts. Okay. All right. Blake.
Hello.
Blake, welcome, man. It's been a minute.
Thanks for having me, man. It has been, but I'm glad to be back. And I'll tell you this, Anthony, if I look as good as you do when I'm 65, I'm going to be a happy man. So thank you. Thank
I
you for having me
appreciate
on.
that, man. I appreciate that.
Yeah, man.
Every now and then I'll cut my hair and I'll cut it down real short, and I'll get rid of most of this stuff in here. I'll cut that down real short. Believe it or not, underneath all this white stuff is still some black hairs, right? And I'll cut it down, and
You
every
don't need
now and
to.
then
Oh,
somebody will give me a compliment and say, you must be like, how old are you? Like 45, 47?
there you
I'm
go.
like, oh yeah, I already love you.
That's awesome. I love it.
Hey, listen, Blake, there's a lot of stuff going on today.
Yes.
A lot of stuff going on today. And a lot of people are really worried about what's going to happen with their retirement. What's going to, a lot of companies have made a big shift to where they are no longer offering pensions. There's a company here in the area where I live. They make private jets. A few years ago, they took it upon themselves. They canceled all of their pensions for employees that was still working, and they rolled that money into 401ks, whether they wanted it or not.
Right.
And so a lot of people don't understand the I can't say danger of a 401k, but a lot of people don't understand what happens when they begin to use that money that was rolled over, because the pension saved people a lot of money.
Sure.
It saved people a lot of money. But today, it's almost a thing of non-existence.
Correct.
Where people don't um, know what's going to happen. They didn't realize. I was talking with someone one day who had to take some money out of his 401k, and he took money out of his pension before. I mean, not out of his pension, but out of the 401k. And he think he could work it just like a bank. He didn't understand that there was a penalty because he wasn't 59 and a half.
Ouch.
He had to pay taxes.
Yep.
And then he had to pay whatever company what was handling that 401k, he had to pay their fee. And he was so mad, so upset. And I said, look, that's just the nature of the beast.
Yeah.
That's how it is. You need to put your money into something that is going to be more protective.
Correct.
And we were talking, and then he just comes out and he says, I used it all.
Damn.
I said, you did what? He said, I used it all.
He couldn't even borrow against it to maybe not, use it all. He just took the withdrawals and
he just took the withdrawals. I was like, man, wow. I said, wow. I said, well, I'm almost speechless at that point. And so we started talking, instead of rolling it over, we started talking about IULs.
Yeah.
And I said, look, that's something you may want to do. You may consider it. It's kind of late in the game, which means you're going to have to put more money in to see faster growth in your cash value, And so, but I know now you're with AMS. Tell us a little bit about AMS.
Yes, sir. So I work for a company called Annuity Marketing Services, and we are what's called in the industry an IMO, an independent marketing organization, or a third-party distributor, which basically means we distribute and wholesale fixed and indexed annuities and some life insurance in the financial services industry to folks at your company, to banks across the country, to different broker dealers. And we primarily work in that annuity arena. And as you mentioned right now, I mean, what we do is we try to educate, do, case design, consult, for folks who, just as you just mentioned, want to put some guarantees and some protection into their retirement plan. I mean,
All right.
that's really the simplest nutshell way to go. But being part of an IMO means I don't work directly with an insurance company, meaning I don't get paid by an insurance company. I can offer multiple different carriers. At World Financial Group, we work with Nationwide, Global Atlantic, Athene, Allianz, F&G, North American. So, we're kind of agnostic when it comes to a product. We just want to help your clients find the best fit for them and their particular situation, because no two people are alike. It's not like, the old days, you come into a bank, open an account, everybody gets a toaster, right?
Mm-hmm.
We want to we want to design plans specific to your specific clients and their specific needs.
Okay. All right, man. That's so. AMS, Annuity Marketing Services.
Yes, sir.
How long have they been around?
So they've been around since the late 90s. So around 90. Actually, I take that back. Since 91.
Since 91.
Headquartered, their home office is in Baton Rouge, Louisiana. But we have people all over the country. I happen to cover your area. So my territory is Florida, Georgia, Alabama, Mississippi, and Louisiana.
Okay.
Yep. And we have an outside sales force, which I'm part of, which means I travel, quite a bit and do these types of meetings in person and virtually. And then we also have a great team of internal partners that work with us directly, the externals. Then we also have a really good sales desk that's there to just kind of react and take, run illustrations, get things out to you quickly. And then, of course, we service all of the policy needs pre-sale. So anytime you write an application or a contract, somebody says, yes, let's do it. We're going to make sure that application gets through the process and, gets issued as quickly as possible.
Wow. So what's the usual turnaround time? Or is there a thing called an average turnaround time?
So the simplest way to kind of define that, I would say there's two. So if this is a cash application, meaning I'm just taking some money out of the bank, so I'm funding this right now. And by the way, most annuities that we talk about, and you mentioned IULs, unlike IULs, we're doing these with lump sums, right? Single. We do have a couple carriers that will take additional premiums, but really annuities aren't built for that.
Right.
That's just kind of something those carriers will do because there's a small market need for it here and there. But the majority of the business is going to be a lump sum contribution. I pay for it once, set it and forget it, and it does its thing. So if it is a cash application, meaning I've got the money right here, that's probably going to be turned around. And if everything goes smoothly, we do the app right, there's no questions, all that kind of stuff, probably a couple weeks, right?
Okay.
2 weeks-ish on average. If we are trying to get money, so let's say we're writing one of these and it's coming from a 401k or an old annuity, right? And remember too, for those folks out there, if you do that, right, and you're rolling it into an annuity, that there is no taxable consequence, right? So that's the beauty of doing that, is you're moving it from a 401k or an old IRA or an old annuity, and you're moving it into a new traditional IRA.
Or wait a minute. Let me back up a minute. Could you say that one more time about tax consequences?
Yeah. So if I've got a 401k and I retire or leave my job and I want to move all or some of that money into another tax deferred qualified vehicle, I can do that. And there is no tax consequence to me, right? The government allows, the IRS allows us to do that because it's moving from one custodian, right, from one plan to another. They allow individuals to do that with absolutely zero tax consequence.
All right. So if the person is under the 59 and a half age, still tax consequence.
Correct. The 59 and a half rule. So I'll back up on that. Well, let me finish my average processing time. So I'll just
go right ahead.
Yeah. But you give me great questions. If we're moving money from a 401k or an old annuity, it's going to take a little bit longer, maybe 5 to 6 weeks, depending, because once we get the transfer paperwork to the surrendering carrier, they're going to do a lot of their back office processing, things like that. And at that point, it's really out of our control.
All right.
So those can take a little bit longer. But again, if everything's in good order, if it's
Mm-hmm.
cash with app, on average, probably a couple weeks turnaround. If we're doing some kind of transfer from another company, that's going to take 5-6 weeks. And again, on average, so sometimes it takes longer, and sometimes it can be very quick.
Okay.
But back to your 59 and a half rule. So what that means, and what Anthony's referring to, is this: if you have money in a tax deferred vehicle, whether that be your 401k, annuities grow tax deferred. And what tax deferral is it literally means you defer your taxes on any gains until you actually take that money in hand,
Mm-hmm.
cash in the contract, put it in your pocket, and go to spend it. As long as you're leaving that money within those qualified plans, even at transfers, there is no tax consequence. However, the trade-off is this: Uncle Sam says, I'm going to let you do that.
Mm-hmm.
But one of my stipulations, meaning Uncle Sam, not me, is that if you try to take those withdrawals and take any of that money in hand in cash before you're 59 and a half, you're going to pay taxes, right? But you're also going to pay another 10% IRS penalty, which unfortunately is what the gentleman you were referring to earlier faced. So not only did he pay taxes, but
Yeah.
however much he took out, he also had to pay another 10% penalty. And then but that's really the trade-off, right?
Mm-hmm.
I explained to everybody, look, Uncle Sam, whether you have, use pre-tax dollars to contribute to your 401k, or you're using tax deferral, or you're using both together, Uncle Sam will get his at
Right.
some point,
Right.
right? So 59 and a half is where you have to leave it alone until.
Mm-hmm.
And then if it is qualified, meaning it was a 401k or an IRA, I've never paid taxes on anything that went into it or any of the growth, then when I turn 73, I am then
Mm-hmm.
required to start taking distributions. It's called an RMD. It's called a required minimum distribution. And that is something,
Okay.
whether I, as a 73-year-old, even if I don't need it, I don't want it, I have to take it. Because if I
Okay.
don't, I'm getting penalized much worse than I'm getting penalized on my pre-59 and a half rule. So
Wow.
those are just some kind of parameters for things to think about. And I think we're going to get to that here in a second when we talk about making our money last.
Okay.
But I'll stop there and see if you got any additional thoughts, questions, or what else I
Yeah,
could address.
well, you know what? I'm over that 59 and a half, so I don't worry about that anymore. But a lot of my clients are not.
Yep.
All right. Now, this is the problem that they're running into. At their jobs, they're telling them, you can't touch that money. You can't touch that money until you're 59 and a half. And I'm talking about people that have left that job.
Right. That's not true.
Not people that are still there working.
Right.
Now I know some of the companies that when they have a 401k, that money may be locked down until that person either retires, is laid off,
Yeah.
or resigns.
Yeah.
But then that money is available to them. Now,
Correct.
what they're hearing, because what I'm hearing from them is that they're told they can't touch that money until they're 59 and a half. And I'm telling them that's not true. That's not true. I said, we need to roll that money over.
Yeah.
All right. So that your money could make money for you. We need to put it somewhere safe. Now, 401ks are still susceptible to loss. Is that correct?
Absolutely. And that's a great point. And look, I am pro 401k. If you are still working, if you are in that job and they offer a 401k, absolutely contribute, even if it's 1%.
Yeah,
right? Because
I agree.
most 401k plans are going to offer some kind of company match, meaning if I put in 1% or 3%, the company is also going to add 1 or 3. So it's basically like getting free money.
Mm-hmm.
And look, everybody who can do that should do that. It's smart. It's pre-tax dollars, meaning it just comes out of your paycheck before you even see it and feel it. So we just adjust our lifestyle, right? It's not like, hey, I got to pay my 401k bill this month, right? It's nothing like that. It just comes out pre-tax dollars.
Mm-hmm.
But what we run into, and to your point, is this: once I leave a job, I retire, I'm laid off, I move, relocate, whatever the case may be. I should want to and should move that money out of there for the very reason that you just mentioned, is that once I'm no longer contributing and getting that free match, now it matters a little bit more if I have market gains and market losses, right? Because 401k does not protect against any market loss. My 401k could grow 10% one year. The next year it could decline 20%. I have no safety or protection. Now, again, they're not bad. I mean, especially most people who are contributing to 401ks, that's when we're working in our 20s, 30s, 40s, 50s.
Right.
That's what we should be doing, right? But the reason you want to get that money out of that 401k is you get more control over it now, right? You can now decide what you want to do with that money. The second thing, as we just touched on, is especially if you want to protect from any loss, we can take some of that 401k money and put it in something like an annuity that's going to protect from the downside, meaning even if the market is down 10, 15, 20%, they're not going to take any loss. And then third, and I think this is the main topic, right? And this is kind of what you and I have been talking about, is 401ks don't provide any lifetime guaranteed income.
Nope.
Right? If I retire and I just take my 401k out, and let's say I'm over 59 and a half, so don't get hit with any penalty, but I just say, hey, I'm going to, saved up, I invest in the 401k, that's for my retirement. I have no guarantee that money's not going to run out, right? Especially if I start taking withdrawals and there's a bad market or two, right? And look, people are living longer, healthier lives. So retirement isn't as short as it once was. So we need to make sure that some of that retirement money, and not all, because we can't put all of our money in an annuity, right? We got to diversify. We got to have some cash. We got to have some other things. But we want to make sure we allocate enough to provide us with a lifetime's worth of income that will never run out. And we can use that however we want. We can say, hey, that's my living expenses budget. Or maybe they've got that covered. They got their house paid for, no car payment. Maybe this is their retirement. Their travel budget. This is how they're going to spoil their grandkid, right? Everybody's going to have a different need. But what we want to do is make sure that some of those assets, A, are protected from downside, right? No loss. And B, that they never run out of an income stream.
Wow. Hey, look, we got to take a short break. We're going to come right back. But I just need to do this commercial for these folks that's paying the bills. And we'll be right back. Hey, folks, thank you for being with us today. Listen, very, very important. You want to make sure that if you have opportunity, you need an attorney, you need to go to Davis, Bosman, Johnson Law Firm, the law firm that gets great results. Now, their phone number is 912-225-1600. The great thing about these folks is that they have offices in Savannah, Atlanta, and Statesboro. You hear me? Atlanta, Savannah, Statesboro. What are they trying to do, man? They're growing all over the state. All right, so they're there for you. Remember, their number is 912-225-1600. Their website, www.dbjlaw or dbjlawyers.com. All right, you definitely want to check them out. Hey, I have one more person you need to think about, and this is a cleaners, right? It's called One Price Cleaners. Now, the information is scrolling on the bottom of the screen. One Price Cleaners, Garden City, Georgia, at the farmers market on Highway 80. They're black owned and operated. Best prices in town, so I heard. I haven't been there yet, but one of these days, I'm going to go. Man, my schedule is so full. I don't know how many clothes. My wife keeps saying to me, honey, when you going to bring these clothes to the cleaners? And I said, I become speechless, right? I said, honey, I'm going to get over there. I'm going to do it. I've got to get it done. All right. So listen, folks, I want you to stay right there. We're coming back right now with our guest, Mr. Blake Grant. Blake, thank you so much, man, for being with us today. Now, I want to ask you something. I want to ask you something. Annuities are structured a couple of different ways. All right. They could accumulate cash, and they do. They accumulate cash. They don't have a downside, really. I mean, when I first heard about that, I said, what? No downside? I said, man, that's better than sliced bread. I said, no downside. All right. So tell us a little bit about the different types of annuities that's available and explain to us the participation rate.
Yep. Awesome. So the way I generally get to the annuity conversation, Anthony, is this. And look, the great thing about annuities, I want you to think of them as kind of a Swiss Army knife. They can really do a lot of different things. And that's why I said we with WFG, we work with 7 different annuity companies that have multiple different annuities. And so, like I said, we can kind of customize and really case design and build something specific to each client. But if you think about annuities in 3 main buckets, right? The 3 big ones, there's other smaller peripheral buckets and things we can do. But if you think of them in 3 ways, and the first bucket is, as you just mentioned, I just want to grow my money safely.
Okay.
Right. So maybe I'm still in my 40s, early 50s. I'm not yet ready to think about guaranteed lifetime income, but I want to get my money out of my 401k because I don't want to take any loss. I'm just concerned with safe growth. Right. So we're going to allocate, we're going to use some different types of ways to make money, whether that be the S&P 500, the Russell 2000. But the great thing is my money's actually not in those vehicles, right? We just get to participate without being exposed to them. And what I mean by we participate without being exposed is we are not exposed to any of the downside. So for a safe accumulation, this is a perfect place to talk about a participation rate. You may have a strategy that says, let's say in the S&P 500, I think most people are familiar with that. We'll keep it simple. I'm going to participate in 50% of the S&P 500's return. Right?
Okay.
Now, some people say, like, well, why am I only getting 50? Well, you're only, and I would say that's a good number. You're getting 50%, but you're getting absolutely zero loss. So as an example, last year, the S&P returned just over 20. Oh, no, I'm sorry. S&P was up 24%, right? Almost 25% last year. Okay. Pretty strong year after being down almost 20 in 2022, right? So it was down in 2022, came roaring back up 24% last year. So if I had money in an indexed annuity in 2022 and I was allocated to the S&P 500, I took absolutely zero loss. Right? Wow. So as an example, let's say I had $100,000 in that annuity. At the end of that year, I still had $100,000. I didn't have $80,000. I didn't lose 20% of my value. If I had been in the market, if I had been in an S&P 500 mutual fund, I would have taken 100% of that loss.
Wow.
Now, in 2023, the S&P 500's up 24%. Right now, I'm in a 50% participation rate strategy, which means I get half of that 24. Which means if I was in the S&P 500 last year, I took no loss the year before, but I made 12% last year because I got half of that 24. And over the long haul, not losing is going to help people actually make more money than if they're always in the ups, the highest highs, because they're always going to have to then take the lowest lows. And the example I give is this. If I lose 10%, I have to make 11 just to get back to even, just to get back to zero. If I lose 20, I got to make 25 just to get back to even. So if I'm 60, 65, I may not have the time horizon for those kinds of returns, right, to make up for that loss. And I also may just not have that tolerance for that kind of volatility anymore. So that's how the pricing, that's how you make money in these annuities. But first and foremost, and we can get some good, solid, steady returns. But first and foremost, it is about protection, right? It is about protecting that asset from loss. Does that make sense?
Absolutely. Absolutely. And it's interesting. We use the word asset. That money is an asset, just like a house is an asset. Yes. All right. A house is a tangible asset. The interest that you earned is an intangible asset, but it's an asset. Okay. Now, this is extremely important to understand that in a down market, you're not losing any money.
Correct. Zero
money. You're not losing any money. Man, listen, what I've known people that say, I'm gonna put all my money in real estate. I'm gonna put my money in real estate. I said, that's beautiful, that's fine. I said, that's good, that's a great thing. Awesome, good idea. I said, but there's only one problem. They said, what? I said, what if your tenant doesn't pay the rent?
That's right.
I said, listen, the only thing that you have that's guaranteed value, because I sold real estate, Blake, for 12 years.
Okay.
The only guarantee you have that will gain any type of appreciation is the land. That's the only guarantee. Why is that the only guarantee? Because the house could burn down. The house could lose value. All right. But the land, although the house burns down, you could sell the land, or you could lease the land. You could rent it out. You could rent the land and somebody could put a trailer on it. All right. It's still holding some value. So that's very important. So it's an asset, the interest that a person owns or earns, in an annuity isn't lost. What happens to it? It becomes part of what?
Yep. So great point. So let's just take that same example. So last year, let's say I had $100,000 in, and I was in a 50% participation rate with the S&P 500. It was up 24, so I made 12. So now my new account value is 112,000, and that will never depreciate. That is now my new floor. That is my new worst case scenario. So even if this year or next year the S&P takes a loss, which means I don't lose anything, but I also don't make anything, but at least I didn't lose anything. That means my 112,000 is now locked in until I make money again in another contract year, right? So S&P will perform again. And I'm glad you brought that up, because that goes back to that tax deferred conversation we had at the top.
Right.
Remember too, folks, that $12,000 I made last year, I don't get a tax bill. I don't get a 1099 on that. So that allows that money to grow on top of itself and compound over the course of time until I actually need to take it and spend it, turn it into income or what have you.
Wow. All right. Now, listen, that is an income product, or is that the accumulation?
So that is just a simple, straight accumulation. I'm not buying income yet. So that was my first bucket, right? Safe accumulation. My other two buckets are I need income now or soon, or I want to guarantee my income later. And when we say now or soon, immediately or in the next few years. Later means, hey, I want to turn this thing on and start taking my withdrawals in maybe 5 to 10 years, right? So my other two buckets are I need it now or soonish, or I've got a few more years until I want to start taking those withdrawals, but I want to lock it in now. I want to know what I'm going to get in 5 years or 7 years or 10 years when I retire, or when I want to start taking these distributions. And that's where we come into play, and is what you do with your clients is we can show them how we can build that income plan, right, to make sure that they've got enough to allocate for expenses or vacations or whatever they want to do or however they want to spend it. But they know that that is a guaranteed paycheck. If they live to be 150 years old, they are going to continue to get that paycheck, even if, and if they live long enough, I'll say even when that account value is at zero. Right. Just because I run out of my asset doesn't mean I run out of income. And that there's only one product on the planet that can do that. And that is an annuity. There is nothing else that can guarantee a client never runs out of an income stream.
Wow. Because look, I've met people. Who their 401 ran out. It ran out. I met a girl whose father has a 401 and a Roth. And in 2022 or 21, he lost money in both of them, and he's retired.
Yeah.
And he's retired. And I said, look, why does he still have a 401k? I said, why is he letting it stay at that? Well, why don't he move it?
Yeah.
You know, and Blake, she is a licensed insurance agent. Okay. But she focuses in on Medicare and
Right.
Medicaid, you know, so she doesn't do what I do.
Yeah.
Listen, folks, this thing is serious. Warren Buffett said something. He said, never put your money somewhere where you're going to lose it.
Yeah.
Now, I don't know if those are his exact words, but that's what he said.
That's the gist of it. Yeah.
That's the gist of it. Yeah. Why would you keep your money at a company that you no longer work there? And I look, I got off the phone with somebody a couple of days ago. He retired, and he said, I need to know what to do with this money. He's been retired for several months now. All right. And I tell people all the time, you know, your money not safe. You're not there anymore. Your money's not safe. Your money's not safe. So this is extremely important. Now, we talked about the accumulation.
Yeah.
All right. Now there's income.
Yeah.
All right. Now let's say someone health-wise, we a couple of minutes, we have to take another station break. Let's say someone's health is bad and they don't qualify to get long-term care insurance.
Yeah.
Annuities could step in and help in that area. Could you talk a little bit about that?
Absolutely. So that's a great point. I said earlier that, you know, annuities can be kind of a Swiss Army knife.
Mm-hmm.
You know, we start with those three main buckets: safe accumulation, income now or soon, or income later. But with some of our solutions, as you just mentioned, they also have additional benefits that can help cover potential long-term care type needs. It's not long-term care insurance, right? But you qualify the same way, meaning if I'm in the annuity, and by the way, so folks understand too, there are no health requirements to purchase an annuity like life insurance, right? I just need to be financially suitable. I just need to be financially suitable, right? I just got to have enough money and I got to be diverse, but I don't have to be in great health or in good health at all. But let's say I'm in my annuity, I've got an income, you know, I'm taking some income. That's what I've used this for. And then somewhere down the line, I can't perform 2 of the 6 activities of daily living. Some of our products will then double that income payment. So let's say they were guaranteed $10,000 a year forever. They will then double that income payment to 20, and they'll do that for up to 5 years or until they don't need it anymore. And then at the end of that 5 years, or when they stop needing the 20, it will go back down to that original $10,000 a year payment and will go on again forever. Pretty strong stuff. And especially for folks, folks who can't health-wise get LTC, long-term care, or for those folks who just can't afford it, right? It's traditional long-term care is very, very expensive. So annuities are another way to kind of bridge that gap. And it may not cover the whole bill, but I'd rather have some than none.
That's right. That's right. Hey, now let me ask you something here. The minimum a person could start an annuity or open an annuity with, in most cases, is going to be around what, 10,000?
Yep. Every carrier and every product we work with is a little bit different, but the smallest premium we have on our shelf is 10,000. And we have some that you have to get in for 25, 20, but it's going to be, generally speaking, you're looking at 10,000 and above. Yes, sir.
Okay. All right. Great. Well, I'll tell you what, This has been extremely informative. Hey guys, don't go anywhere. We'll be right back with Blake. We have to take another station break.
Many North Americans, a dream is nothing but an old-fashioned idea replaced by the harsh reality of a modern world. Longer work hours, higher debt, fewer raises, horrible bosses, less family time. Who's got time for dreams when everyone's just trying to get by? We're here to officially announce that WSB is bringing dreams back. And we're not doing it for just the ultra-wealthy like others are. We're doing it for everyone, every age, every background, every gender, every experience level. Whoever you are, we're here to help you. And help starts with a financial education. When people know how money really works, they can reduce debt and enjoy the confidence that comes from knowing their families are protected financially. They can discover the excitement that comes from a solid strategy to save for the future and the hope that one day they might become financially independent. But we don't stop there. We open the door to anyone to become a business owner and be part of our mission to help others. We don't want anyone to shrink the size of their dreams to fit the size of their opportunity. That's why there's no limit to how many people can reach our top promotion levels. And that's why we don't put any limits on how much you can earn with us. Success is not reserved for a few. It's offered to anyone willing to learn, work hard, and grow. We believe anyone with the right support can transition from where they are today as someone's employee to where they could be tomorrow as an entrepreneur who owns their future. If you don't build your dream, someone will hire you to help build theirs. When you know how to protect your family financially, when you take control of your money, when you're enabled to succeed, an amazing thing happens. Dreams are all you want to talk about. If you still have dreams, start here.
Wow, that was powerful. Hey, look, if you want more information about that, you see my name, my number, my office information scrolling across the bottom of the screen. Give me a call. We will help you get started in this industry from scratch. But until then, I want to talk about one of our sponsors, One Price Cleaners, Garden City, Georgia, at the farmers market. Hey, you could do all your shopping in one place, right? On Highway 80, they're black owned and operated, best prices in town. I had personal testimony from somebody. One of my guests one day told me, he said, hey, I use them. He said he went there one time, and now that's the only cleaners he'll go to. So they are one of the best around, guys. All right, now listen, you need a law firm. Everybody at some point is going to need an attorney. Well, why not Davis Bosman Johnson Law Firm? The law firm that gets great results. Their phone number, 912, is going across the bottom of the screen, 912-225-1600, with offices in Savannah, Atlanta, and Statesboro. Yeah, but if you're one of those folks that like the computer and you want to look at their website, it's www.dbjlawyers.com. Hey, I'm bringing our guests back, and I know you guys are getting something out of this. If you have questions, put them in the comment, and I'll ask him. All right? Blake, so good to have you back, man. I almost forgot where we left off, but now you've been doing this for quite a while. How long? Because you were doing this before AMS.
Yes, sir. So I've been in financial services since 2001. So I guess about 23 years. I started off as a licensed banker with an old bank called First Union. For those of you who remember First Union,
I remember First Union.
Yeah, now and is now Wachovia. I was a licensed banker for 2 years, and then I moved into wholesaling. I was an internal wholesaler for a couple of years. Then I managed an internal desk, and then I finally got out in the field as a regional vice president in 2010. And I've covered most of my time has been in the South, in the deep South. But my first opportunity is actually up in Ohio. So I covered Ohio and West Virginia for a few years up there. But yeah, I've been doing it. When you ask me how long I've been doing it, and I actually say it out loud, it used to be a job when I started, and I guess now it's a career. So
wow. Yeah. Hey, look, I remember First Union.
Yeah.
They
That's
went
where I
from
got
First Union to Wachovia. There's no more Wachovia.
No,
It's Wells Fargo.
Yeah,
Yeah.
Wells Fargo, so
Yeah.
right.
Hey, look, this is valuable. People, when it comes to retirement, just like anything else, you need vision, planning, and determination. If you don't have a plan for your retirement, then you're going to live with regret. You really are. You have to plan your retirement. You have to. The generation that we're seeing today don't understand planning for retirement. Most of them don't understand vision. They're too caught up in the phone and in the computer, and they give up on things quick today. Unfortunately, in the college system, they're teaching here in the United States anyway. They're teaching them to try a job 2 years or career 2 years and switch to something else, then give that 2 or 3 years and switch to something else. Longevity is not really a thing that's taught today. But in this financial arena of retirement and annuities, longevity means a lot. What could you add to that, Blake?
Yeah, I mean, I think I love the vision, planning, determination idea, and you're right. We are living in a much more microwave society. Everybody wants stuff quick now. Our attention spans have shortened quite a bit over the course of time. But I'll use this analogy, and I love this to kind of talk about why you need to have a plan in place. And everybody knows Mount Everest, right?
Mm-hmm.
Climbing Mount Everest is a big deal. It's very difficult. I want everybody out there to view the climb up to Mount Everest as my working years. That's my accumulation.
Mm-hmm.
I'm going to work hard. I got a Sherpa. I got the right equipment. I got the right tools. My plan, my vision, my plan is to get to the top.
Okay.
That's most everybody's vision and plan. And I got to be determined to do it. But what a lot of people don't realize is that more people die because it's not a safe thing to do. I mean, it can be treacherous. More people die coming down the mountain than actually getting up. Because why? Their plan was to get to the top.
Wow.
Their plan was to get to retirement.
Mm-hmm.
You need to plan to get up, and you need to plan to get down. And getting down the mountain is really that income phase. So we accumulate, we grow, but then what's the summit? What's the peak? Our retirement. I no longer have to work anymore. But if I don't have a plan to get down the hill and make sure it ain't a hill, the mountain, and I don't have that income plan in place to make sure I can get down and get down safely, then unfortunately, as you mentioned earlier, people aren't going to die. I'm not going down that path. But yeah, I might have to start working again. I might have to go be a greeter somewhere or drive for DoorDash or Uber Eats. And look, some people do that because they want to. They like staying busy. But a lot of people do it because they have to.
Yeah.
And that's why the planning piece, and more specifically, having those income conversations is so important. Because look, most people, especially when they're working, they just want to talk about how much I'm saving, how much am I making, what can you get me, what can you get me, right? We've got to, at a certain point, start to have the plan to get you down the hill safely. And that's to make sure that we never run out of an income stream, even if we run out of our asset.
Mm-hmm. Now, some of the annuities that you offer also offer within that annuity, some of the offerings are like they could get one of the indexes you mentioned, 500 S&P 500, but I saw one time for somebody for gold. Yeah. And I was like, and this is and real estate.
Yeah, Yeah, so that's a great point. So I use S&P 500 because I think most people out there, look, I'm a simple guy. I like to keep things simple, but understand too, there's a lot of diversity of options and opportunities within these annuities, and every annuity is going to have different ways to make money.
Right.
But they all offer a certain amount of diversification. And yes, you're correct. You can have your money allocated to crediting strategies that are tracking real estate indices, that are tracking gold. We have international, indices, and we have, and a lot of them too are a combination thereof. So you're not lacking diversification, even though you're really getting a lot of people think guarantees, they think simplicity, which we can make these as simple as you need to be. But you're also, I don't want to sell short the fact that you can also continue, to get a lot of diversification, because look, we don't know from year to year where certain markets and certain, segments might be outperforming others. And so it's, you want to have a little bit of everything. And that's why too, annuities are part of the plan. They're not the plan. So I don't want anybody out there to hear or think we're saying, hey, take all your retirement money and throw it in an annuity. That's not what we're saying. What we're saying is you should definitely have the conversation. And that's why y'all need to talk to folks like Anthony, to have those conversations, to, if you don't have a vision yet, to figure out what that vision is, plan and really develop, and get to that next point. So look, I want to be able to sleep at night, and I also don't want to work till I'm 85 years old.
I hear you, man. I hear you.
So if I don't have a plan, and look, the old saying, right? Failure to plan is a plan to fail.
That's right. That's right.
You got to have those conversations. And I think what you do, Anthony, is great because you bring awareness to folks out there. And look, I know you couldn't catch the one guy before he just started spending down and taking his 401k money, but maybe you get the next one, and you
maybe the
save
next
those
one.
folks some hardship and some heartache. Because look, again, at the top, we can talk about returns, we can talk about paychecks, lifetime income, but really what we're trying to do is protect your retirement.
Protect that retirement. Absolutely.
Protect it. Protect.
And a lot of people don't understand their money can be protected. It really can. You could protect your money. You worked for that money. Why would you want to lose it prematurely? There's three things that's going to happen in our lifetime. We're either going to die prematurely. Unfortunate, right? But people do die prematurely. There's too many graves out there with infants or teenagers, so forth and so on. Or we're going to live too long and outlive our monies, or we're going to get sick. Either way, you have to have a plan in place. Did you know you can actually get a life insurance policy for your baby after they're 15 days old? When they turn 16 days, get them a life insurance policy. Why? That thing's going to start accumulating cash value. Even better than that, get if you're at it, you have to be a certain age. You can't be, you're not going to open up an annuity for your baby.
Correct.
All right. But you could do a life insurance policy, but you can open up an annuity for yourself. And the average age, oh boy, we're running out of time. The average age for someone to open up an annuity, or the age where companies will accept that, would be what? 40?
Around, so the average age, just to kind of put it in a bucket, is around 50, 55.
Okay.
But I will tell you this, after and through and after COVID, we started to see younger people, and I don't mean teenagers, right? But I mean folks in their 40s that started to think more about risk and guarantees.
Okay.
Now, those clients, I'll tell you right now, if you're in your 40s, you're not a guaranteed income candidate yet, but you are somebody who may want to protect that asset. I change jobs, I get laid off, I want to take my 401k and I want to grow it safely, right? So I would still say the average is in the 50s, but we have started to see a movement to some younger folks that say, look, I get it. I still have 20, 25 years of working, but I don't want to lose any of this particular money that I made and earned in my old 401k. So let's lock that in. Let's make sure I never take a loss, right? And then, of course, I'm going to contribute to my next 401k at my next employer, and I'll continue to try to grow that money. And then probably when we get into our 50s, we'll start planning for some income. And again, that depends on when somebody really thinks they want to or would like to retire.
Man, I have so many questions, but we're out of time. Hey, Blake, thank you so much, man, for being with us. I hope you come back. I really do. Anytime. I hope you come back. Now, listen, guys.
Yeah.
Go right ahead, Blake.
Andy, and look, whenever you want me back, we can pick up where we left off.
Oh, man, that'd be awesome. That would be awesome. Hey, guys, let me mention this to you. My next guest is going to be here, I think, the 22nd, if I have my dates correct, the 22nd of this month. And you don't want to miss it. She is a CPA in D.C., in Washington, D.C. area. All right? This girl is serious. But she's going to tell us something about taxes. Because I know you folks have some money, and you're tired of losing money. You're tired of paying Uncle Sam all your money, and you want to know what you could do. All right? We are telling you right now that you could protect that money, have that money grow tax deferred. All right? But then she's going to tell you about the tax issue, okay, in other areas. So, Blake, thank you so much for being with us today. Man, it was an honor and a pleasure to be with you. And we just hope that that you come back soon, man. You come back soon.
Anthony. I always enjoy it, and I really appreciate the opportunity to share. And like I said, man, I love your energy. I think what you're doing and getting the message out there is awesome. There's not enough people like you out there. So I appreciate what you do, and I appreciate you having me on. And like I said, you pick a date and we'll make it work.
Sounds good. All right, buddy. We'll see you next time.
Thanks.
I like that.